Hello, once again, Meager Millionaire fans. Do you guys like pet rocks? I love pet rocks, alright? So I've got a little article out of youshouldbuygold.com. I've never actually been on this website. It's my first time coming across it today, but I thought there was a kind of an interesting article I'd like to bring to your attention. If you get any kind of value out of these videos, please like, share, and subscribe. Please, please, please. Anyhow, so, naked silver shorting, all right? I'm going to read this article. I'm going to give my 2 cents as I go through it, and I want you guys to let me know what you think. Backstory, I believe that the BRICS nations are going to try to corner the metals markets. I believe that they're going to try to force some price discovery, and I'm not quite sure what that's going to look like as far as gold, silver, platinum, palladium, rhodium, whatever you can get your hands on, precious metals. But I bet you it's going to be higher. So, of course, I have no idea what I'm talking about. I am not a financial planner. I have no idea. So don't listen to me. Don't listen to me. Farmers, airlines, and manufacturers lock in their costs for commodities by using the New York Commodities Exchange. I'm sure you've all heard of the COMEX, right? Rather than speculating, they buy and sell commodities to hedge their costs. So on the other hand, the majority of those who buy gold and silver derivatives, so derivatives of gold and silver would be GLD and SLV, are short-term speculators. Buying or selling on margin gives speculators tremendous leverage. The usual gold or silver buyer is not interested in acquiring actual bars, but in making a quick profit. That's the worst thing you could possibly do. If you're a stacker, you certainly want to buy real, physical, tangible, in your hands assets, not paper derivatives. The buyer of one silver contract, for instance, is long 5,000 ounces of silver. The buyer of one gold contract is long 100 ounces of gold. To complete the transaction, what is purchased must be sold. The buyer's profits if he sells the contract at a higher gold or silver price, all right? So if he buys it at $1 and it goes to $1.10, he's making the extra 10 cents, right? Commodity investors, traders can also take negative positions. A short seller sells what he does not own. To fill the contract, he must buy back what he originally sold. A short seller makes a profit if he can buy a commodity back when the market drops. So if he, buys it at $1, but he really only wants to pay 90 cents for it or something like that. When buying long or selling short, transactions are not complete until the corresponding transaction is executed. The short profit if they can buy a commodity back when the market drops. If they misjudge and the market goes up, they either cover their shorts or take a huge losses. Or they have to get a margin call. You don't want a margin call. Nobody wants a margin call. And hold on their contracts with their teeth gritted. Yeah, you'd be crapping your pants if you get a big margin call. I'd be tripping. They're leveraged with a certain percentage down, controlling 5,000 troy ounces of silver per contract or 100 troy ounces of gold per contract, all right? There is a delivery month when a commodity contract expires. In theory, all buyers can pay for contracts in full and take delivery of the silver or gold. In the past, it is possible for anyone to take delivery of silver on the delivery date of that contract. That is no longer always the case. All right, so here's where it gets really interesting, all right? Fails to delivery. Shorts are squeezed during rising markets when covers are impossible to find to close out their short position. It is called failed to delivery when a bullion house are unable to secure the silver or gold to fill the delivery order. It doesn't just have to be precious metals. If you guys recall, not too long ago, there was the nickel market that blew up. That was the thing. Look it up. Okay, so the COMEX can limit delivery of silver to 1.5 million ounces to any individual when demand overwhelms supply. The exchange has a clause that allows for a cash settlement instead of delivery of physical metal. So you guys did have a 1,000 ounce or 5,000 ounce contract of silver, and you guys did stand for delivery, but we really don't have it, so we're gonna have to cash settle. How do you guys like that? I don't like those apples. The default mechanism for fails to delivery is cash settlement. Since 2011, delivery contracts have been quietly settled in dollars rather than in precious metals. Ooh, that sounds like a really shady industry, perhaps. Industry watchdogs say cash settlements are getting larger and more frequent. It is rumored buyers who are largely contracted to take physical silver delivery instead are paid dollar premiums as high as 20 to 30% as an incentive on settlement. Okay, so you come, we don't have the actual commodity good, but keep your mouth shut. We're going to give you an extra 20, 30%. How's that sound? This is out of control, people. This is out of control. All right? A commodity short sale is naked if the seller does not have the goods to fill the contract. If he sells silver or gold without ensuring it can be borrowed or secured, the corresponding half of the transaction cannot be fulfilled. The naked short seller cannot fill the order because the commodity is not available. So what's going to happen, if, like, let's say one of these places does have a failure to deliver, what do you think is going to happen to the price of pet rocks? What do you think would happen to the price of oil? What do you think of any of these things? If there's nothing, everybody wants it right now. Look at houses back in the pandemic and all those things. People were going nuts, right? Going nuts. Naked short selling drives down prices to levels that do not reflect true supply and demand. All right? Sound like anything that we might be collecting ourselves? All right, so it goes into bullion banks here. Bullion banks are members of the London Bullion Market Association, the LBMA, all right? Bullion banks are investment banks that function as clearing banks, wholesale suppliers of gold and silver bullion. The banks conduct the financial transaction and ownership transfer of precious metals from central bank investors, most often gold and silver that has been leased, swapped, or rehypothecated. Banks such as JP Morgan and HSBC perennially hold massive short positions in gold and silver. There are no COMEX limits on speculative positions except in the spot delivery month. An unlimited number of contracts can be sold short. Now that sounds like it's not rigged. It's definitely not rigged. We're definitely not trying to push the price down. Why are they trying to push the price down? Currently, JPM and HSBC and other bullion banks control the open interest on the COMEX or CRIMEX with an unprecedented number of silver short position, numbers of incomplete transactions. Billions of dollars worth of silver must be purchased or delivered to complete the outstanding transaction. Credible industry experts believe that the banks owe more silver than exists above ground. Maybe. Who knows? Since 2007, global central banks, especially in Asia, BRICS, Brazil, Russia, India, China, South Africa, all these boys have been mass accumulating it. But guess what? Nobody's been really talking about it. Have been gradually unloading dollars on the exchange. Instead of taking the profits in dollars, mega buyers have been paying off contracts and taking delivery of massive tonnage of physical metals. When silver or gold breaks to the upside, the bullion banks increase their naked short positions to suppress the price. The ongoing tug of war between naked shorts and big players who are unloading billions of dollars for gold and silver is causing tremendous volatility. We are just one crisis away from a physical silver and gold run. All it would take to trigger a default, even event, is for one large bank or country to refuse cash settlement and demand actual gold and silver delivery. Currencies and entire national economies can be and have been brought down by naked shorting. The practice threatens broader markets and could be the catalyst to shatter global confidence in the dollar. All right. So now we have this article read. Let's think this through. Just the other day, BRICS come out and said that they want to start their own precious metals exchange, all right, to get price discovery. Now, if we believe, let's say, that there's a pile of naked shorts out on all these metals markets, all right, and another exchange opens and they get, some price discovery. Well, all these naked shorts would then have to cover, at least in theory. And if a whole bunch of covering and margin calls and all these things were to transpire, a short squeeze that wouldn't even make sense could occur. I don't know if this is going to be the case. I'm willing to bet on it, and I am betting on it. But, that's not really the reason that us stackers, we're not really betting on the price exploding. We're just really hedging the dollars in our pocket that are going to go up in smoke and erode. It is for certain that the government's debts and deficits will continuously expand and the currency in your pocket will be worth less and less and less. Now, if there's ways that we can arbitrage this to become wealthier as people and stronger as a nation, why shouldn't we? Clearly, the rest of the world, at least from what I can tell, is getting kind of sick of getting something for nothing. Seems like a big portion of the world is going to go back to a sound money currency. And if we as individual investors and stacking community can arbitrage this and, take back what's ours, I say all the power to us. So, none of this is financial advice. I have no idea what I'm talking about. But please come back for more with the Meager Millionaire.